Welcome back to the channel. I'm Algabot, and today we're taking a close, educational look at an expert advisor for MetaTrader 5 called Price Density Trend Breakout. This strategy is built around a lesser-known measurement from Kaufman called price density, which reads how tightly price is packed inside a window of bars. By the end of this video, you'll understand how the strategy separates choppy, range-bound conditions from clean directional moves, how it decides to go long or short, and how it manages risk with an ATR-based stop and target. Remember, this is educational information only, not financial advice. Let's dive in. Let's start with the big picture. Price Density Trend Breakout is an automated strategy, an expert advisor, that runs on the MetaTrader 5 platform. It's designed to study a single chart on a single time frame, and a liquid foreign exchange major such as Euro-US dollar or British pound US dollar on the 30-minute or 1-hour chart makes a sensible educational playground. The engine behind it is Kaufman's price density. Here's the idea in plain terms. Over a window of the most recent bars, the strategy adds up the height of every individual bar, from each bar's high to its low. Then it compares that total travel against the net distance covered, measured from the highest high to the lowest low across the whole window. When price keeps retracing over the same ground, those bar heights pile up while the net span stays small, so the ratio is large. We call that a dense, choppy window. When price marches cleanly in one direction, each bar breaks fresh ground. The total travel roughly equals the net span, and the ratio collapses toward 1. We call that a sparse, trending window. So the strategy is essentially a chop versus trend detector. It patiently waits while the market churns sideways, and it pays attention when the density collapses, because that collapse is a sign that a directional leg may be emerging out of consolidation. Who is this style suited to, in an educational sense? It's aimed at people who are curious about trend following and breakout logic, and who want to see how a classic market structure measurement can be coded into rules. It only holds one position at a time per symbol, and it leans on an ATR-based stop and target to define its risk on every trade. As always, trading carries real risk, and losses are part of the picture. This breakdown is for learning only. Now let's walk through the exact rules, step by step. The strategy only evaluates its logic once per completed bar, so it's patient and it isn't reacting to every tick. First, it measures the current price density over the chosen window, which defaults to 20 bars. It also measures the density 1 bar earlier. This pairing lets it detect a fresh collapse rather than a state that has been true for a while. The core entry condition is what the strategy calls ignition. The previous bar's density must be above the MaxDensity threshold, which defaults to 2.0, and the current bar's density must have dropped to or below that same threshold. In other words, the market was dense and choppy, and it has just become sparse and directional. That downward cross through the threshold is the moment of interest. But a collapse alone doesn't tell you which way to trade, so the strategy adds 2 direction filters. It measures the net displacement across the window, comparing the most recent close to the close at the start of the window. And it works out the midpoint of the window's range, halfway between the highest high and the lowest low. For a long, the net displacement must be positive and the latest close must sit above that mid-range. So the strategy is joining a move that is genuinely pushing higher. For a short, the net displacement must be negative and the latest close must sit below the mid-range. If neither side lines up cleanly, the strategy stands aside. Once a direction is confirmed, risk is defined using the average true range, or ATR, with a default period of 14. The stop-loss distance is the ATR multiplied by the stop multiple, which defaults to 2. The take-profit distance is the ATR multiplied by the target multiple, which defaults to 3.5. That gives a reward-to-risk shape of 3.5 to 2, or roughly 1.75 to 1, planned in advance on every trade. For a long, the order goes in at the ask, with the stop below and the target above. For a short, it goes in at the bid, with the stop above and the target below. Finally, the exit logic. While a position is open, the strategy keeps watching the density. If the density re-expands back to or above the exit density threshold, which defaults to 3.0, that tells it the clean leg has decayed back into chop, and it closes the position. Otherwise, the ATR stop or target does its job. Only one position is held at a time per symbol. Let's look at the actual MetaTrader code that makes this happen, the same MQL5 you'd see if you open the Expert Advisor in MetaEditor. At the top are the input parameters you can adjust in the strategy tester. DensityPeriod sets how many bars go into the density window, defaulting to 20. MaxDensity, at 2.0, is the level the density must collapse through to signal a trending condition. Exit density, at 3.0, is where the trade closes if chop returns. Then ATR-period, AtrStopMult, and AtrTargetMult control the risk sizing, and lots sets the order volume. Now the signal logic. The line that defines ignition checks that the previous density was above max density and the current density is at or below it, that downward cross we discussed. If that isn't true, the function simply returns and waits. When it is true, the code computes the window's net displacement and compares the latest close to the window midpoint. Look at the buy block. Go long is true when displacement is positive and the close leads above the mid-range. The entry is taken at the ask price. The stop loss is set the stop distance below the entry, and the take profit the target distance above, both normalized to the symbol's digits, and then trade.by places the order. The sell block mirrors it exactly. Go short is true when displacement is negative and the close sits below the mid-range. The entry is taken at the bid, the stop loss is placed above the entry, the take profit below, and trade.sell submits the order. Both sides carry a stop and a target from the very first moment, so risk is defined up front. Let's bring the whole idea to life on this illustration. Along the bottom, you can see the price density panel, our chop versus trend gauge. The gold dashed line marks the ignition level at 2.0, and the red dashed line marks the exit level at 3.0. When the gauge is high, up in the red zone, the market is dense and choppy. When it collapses down into the green zone, the market is sparse and trending. Watch the first several candles. Price is drifting sideways, with bars overlapping each other and no real progress in either direction. Notice how the density gauge below is sitting high, well above the ignition line, up around 3.5. This is exactly the churning, range-bound condition the strategy waits through. It's not interested yet, because there's no clean direction, just a lot of back-and-forth travel over the same ground. Now look at the fifth candle. Price pushes up strongly and breaks out of that little congestion zone, closing near its high. At that same moment, the density gauge collapses, dropping from above the ignition line down into the green trending zone. That's the downward cross through 2.0, the ignition condition. The strategy then checks direction. The net displacement across the window is positive, and the latest close is sitting above the window's mid-range, so both long filters agree. That's where the buy entry marker appears. From there, follow the next few candles higher. Each bar carries price to fresh ground with very little overlap, which is precisely why the density stays low, down in the trending zone. The move extends, one candle building on the last, until price reaches the take profit target, marked above. Because the target was set at 3.5 ATRs while the stop was only 2 ATRs away, this planned move offered more reward than the risk taken, and the take profit closes the long for a clean result in this illustration. After that, watch the market settle again. Price stalls and starts chopping sideways near the highs, and you can see the density gauge climb back up above the exit line into the red zone. The clean leg has decayed back into congestion, and the strategy is once again patient, standing aside and waiting for the next collapse. Now the second setup, this time to the downside. Look at the 11th candle. Price breaks sharply lower, closing near its low and pushing out the bottom of that little range. Down in the panel, the density gauge collapses again, crossing down through the ignition line into the trending zone. This time the net displacement across the window is negative, and the latest close is sitting below the window's mid-range, so both short filters agree. That's where the sell entry marker appears. From there, price works its way down, candle after candle breaking fresh lows with little overlap, keeping the density gauge pinned low in the trending zone. The move runs down to the take profit target marked below, again planned at 3.5 ATRs of reward against 2 ATRs of risk. In this illustration, the short reaches its target and closes. So across the whole sequence you can see the rhythm of this strategy. It waits through the dense, choppy stretches when the gauge is high. It acts only when the density collapses through the ignition line, and it uses the window's own displacement and the position of the close to pick the side. Then it defines its risk with an ATR stop and target, and it will also step out early if the density re-expands back into chop before either level is reached. It's a disciplined, rules-based way of trying to separate genuine directional moves from noise. And to be clear, these are illustrative examples chosen to show the logic. Real markets don't move this neatly, and losing trades are a normal part of any approach. So there you have it, a complete educational walkthrough of the Price Density Trend Breakout Expert Advisor for MetaTrader 5. We covered what Kaufman's price density actually measures, how the strategy waits for that density to collapse from choppy to trending, how it uses the window's displacement and the closing price to choose long or short, and how it defines risk with an ATR-based stop and take profit. Everything here is educational information only, and nothing in this video is financial advice or a recommendation to trade. If you found this breakdown helpful, please give it a like, leave a comment with any strategy you'd like me to analyze next, and subscribe for more MT5 strategy deep dives. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.